Hello everyone, I'm Mark Kinney, Chief Investment Officer of Newport Private Wealth, reporting to you again remotely with our third quarter update. We hope everyone is keeping healthy and safe. This year has been like no other. If you think back to February, stock markets were at all-time highs and unemployment at record lows. Who would have predicted that by September we would have seen over 1 million dead from the global pandemic? Borders closed around the world. Restaurants and retail stores shuttered. The skies eerily silent of airline traffic. Office towers emptied of their workers. Millions suddenly without jobs. Trillions of dollars spent by governments to prevent a complete economic breakdown. And stock and bond markets back to almost record highs. The speed of this market correction and the recovery has been remarkable, unprecedented compared to past corrections. To give you our perspective on these events and what they mean for your portfolio, I'll recap our investment process, which provides context for our thinking, asset mix, and our portfolio activity. Our investment committee scans the environment at a macro level to identify the big themes that will affect investments. There are 3 that I'll address today. First, the pandemic. In the near term, the onset of the second wave of the virus is a concern. Fortunately, we don't see the panic that we saw in the spring, and we don't expect to see a global shutdown, so the economic recovery should continue, albeit at a very moderate pace. Also, the knowledge gained in the first wave about how to treat the virus is helping, and we're hopefully much closer to the creation and distribution of vaccines and antibody treatments. We believe capital markets have mostly digested this risk, though we do expect the odd wobble. Medium to longer term, however, the pandemic is bringing about permanent and semi-permanent changes to how people live, learn, work and play, and spend their money. Underpinning this is massive digital transformation. Not a new trend, but certainly accelerated by the pandemic. We are invested in companies that are beneficiaries of these changes, and I will return to these later. The second macro theme is the battleground of the U.S. presidential election. The fact that polling shows Biden widening his lead over Trump hasn't weighed on the markets. While a Democratic win likely means increased regulation and higher taxes, Biden also promises significant government spending. Stimulus has kept the economy afloat and created the rebound in stocks and bonds. Another package is needed and will get passed, either before or after the election, no matter the result. It should also give you comfort that, as this slide shows, regardless of who is in the White House, U.S. GDP has marched steadily higher. Of greater concern to us is whether the election result is contested and leads to political instability. This would be destabilizing for the economy and could spook the markets. If this were to happen, we expect any pullback to be temporary and of modest proportion because there's a third macro trend that's propelling stock prices higher. Interest rates will be lower for longer. They're now at rock bottom levels and should stay there until at least 2023 and possibly longer if history is any guide. This slide shows yields on 10-year Government of Canada bonds. From 1936 to 2020, you can see they were low for 20 years following the Great Depression. Central banks have said they intend to keep rates low. Inflation remains below target, and weak demand will keep this in check. North America, Europe, and Japan are currently grappling with deflationary forces. We don't believe that inflation is a concern in the medium term. Governments also want to see rates stay low to help them pay for the massive spending unleashed to fight the pandemic. If GDP growth rates are higher than interest rates, governments are better able to finance their deficits without raising taxes or cutting spending. Against the backdrop of these macro trends, our investment committee determines how various asset classes will be affected, how we protect your capital, and how we look to generate returns. We have expertise in multiple asset classes and are not married to any one, so we can be objective and selective about where to place capital and with which independent specialist managers. One thing I can tell you is we would not want to be confined to a traditional 60-40 portfolio of stocks and bonds right now. This slide illustrates our asset mix in a balanced portfolio as of September 30th. We're bearish on bonds and have only a small allocation. Anyone funding their retirement on bonds yielding slightly more than 0.5% can't be happy about the outlook. The next direction in interest rates will be upward eventually, and this is negative for bond prices. We have access to better sources of income. Private debt is one. It's a specialty asset class that consists of many loans to small and mid-market private companies that require growth capital. Our return is the interest coupon on the loan, typically 8 to 10%. We feel this is a more attractive option relative to the slightly more than 0.5% from 10-year bonds. We started adding private debt to our asset mix 8 years ago, and it has performed very well for us. Today it represents about 8% of a balanced portfolio and is diversified across 9 independent managers. Our portfolio emerged from the economic shutdown in good shape, and our managers are well capitalized to provide additional financing where needed. Some of the loans are to companies in the hot sectors of IT and healthcare services. While it's difficult to speak in terms of opportunity amidst human tragedy, the pandemic has made conditions more attractive for private debt lenders, and now they have an essential role to play in financing the recovery. Before the pandemic, there was so much capital chasing deals that borrowers could set the terms. Today, it's a lender's market, and our managers are underwriting loans with tighter covenants, higher yields, and lower debt levels than they were a year ago. In other words, better returns for investors with less risk. We anticipate increasing our investment in this asset class over the next quarter. We currently have about 12% invested in real estate and will likely invest more in the coming months. Real estate benefits from the low interest rate trend, but it is also a tale of subsectors. Industrial and multifamily residential are bright spots, while hotels, retail, and office are troubled areas. This pie chart shows the breakdown of our real estate holdings by subsector. We're in the right subsectors and locations. We own cash flow producing properties with good tenants, and our managers are capable, well capitalized, and use leverage conservatively. Here's a recent and typical example that demonstrates how low interest rates benefit quality real estate. We're part owners of a portfolio of garden-style apartment buildings in the U.S. During the third quarter, the property manager and our partner in the deals took advantage of lower interest rates to refinance 3 of the properties. The net effect is that we now have 107% of our invested capital back. We retain our ownership position, which allows us to participate in future growth, and we collect cash flow averaging 6 to 7% per year from rental income. But it's interesting that the average stock market investor is missing the opportunity. Public real estate, REITs and real estate stocks, were severely beaten up in the March sell-off and have been slow to come back. Our REIT portfolio is still down 10% year to date. But rent collections aren't down 10%. We're still getting paid the income. The average yield is approximately 5%, so we're getting paid relatively well while we wait for prices to recover. There's currently a huge price discrepancy between private real estate values, which are holding steady, and public values. This will correct itself in time. A good example is Cellnex Telecom, which is held in our global REIT portfolio. Cellnex is one of the main operators of wireless telecom in Europe. It operates in the tech space, but in the March sell-off, Cellnex was priced like fashion retail because it's a REIT. Sometimes the baby gets thrown out with the bathwater. Our manager bought Cellnex at €35.9 and it's returned 45% as of September 30th. The market eventually sees the light. REITs are one of the few value plays left in the market, and we plan to increase our allocation in the coming quarters on any weakness. The final asset class I'll comment on is public equities. In a balanced portfolio, they represent approximately 40%. The lower for longer interest rate trend is a major positive. That's because when determining the fair value of a company, the discount rate used to calculate the company's free cash flow is based on interest rates. So when the discount rate is near zero, as it is today, the present value of a company's future cash flows are worth more. This justifies higher price multiples. And yet I know investors can feel nervous given the tremendous run-up in stock prices since the March lows. But if you peel back the surface, it's mostly a handful of big tech stocks representing a disproportionate weight that have moved the market to its current heights. For example, the year-to-date return in US dollars on the equal-weighted S&P 500 is minus 6.28% versus 4.09% for the S&P 500 index. There's still room to recover and grow. Among the 6 big tech stocks, we own Apple indirectly and Microsoft. But there are many other companies benefiting from the digital transformation that aren't trading at the sky-high multiples that big tech commands. We and our independent managers find these more compelling and less risky. Companies like Ansys, Texas Instruments, TE Connectivity, and Broadcom, to name a few. Outside of IT, our portfolio contains many companies that are driving innovation and capitalizing on the changes and trends rising from this pandemic. You've no doubt heard about the shift from cities to suburbs and the boom in home improvement spending, especially on outdoor spaces. A new position added to the portfolio in the third quarter is Trex. It's the world's largest manufacturer of composite decking. Its products are more environmentally friendly and cost-effective than wood alternatives, and they're made in the U.S. Trex's profitability growth was impressive pre-pandemic, and now it has some additional tailwinds. Utilities are another sector helped by lower for longer interest rates. Producers that have renewable power assets are in demand as investors flock to clean energy. Boralex, Brookfield Renewables, and Northland Power are all held in our yield fund, and they were all up nicely for the quarter. Lastly, we own fast growers in the healthcare space. Another beneficiary of the pandemic, most hopeful for all of us, we own companies involved in developing and testing vaccines to fight the virus. Charles River Laboratories and Emergent Biosolutions are held in our North American Equity Fund. They were both up over 27% in the third quarter and over 50% since our manager bought them less than a year ago. I could go on with many other examples, but our message is this. With big tech valuations already stretched and economic footing uneven, we don't believe this is the time to add risk, nor is it a time to be all in cash. Plenty of opportunities still exist for investors that follow a disciplined process, have access to multiple asset classes, including private alternatives, and look for areas missed by the market as we are doing. In closing, I want to thank you for your trust and wish you continued resilience and good health through this pandemic. Please know that the Newport family is healthy, cohesive, and working hard to increase your wealth. Whatever the environment, we will remain active stewards of your capital. If you have any questions, please reach out anytime.